Good evening and a warm welcome to our Let's Learn Futures LLF webinar series. We are delighted to have you today with us here. Before we get started, please confirm that you can hear my voice clearly by typing yes or typing 111 in the chat box below so that I know everything is working well on your side. Great, thank you very much. Now, our topic for today is trade like a machine. Now, this LLF webinar series is proudly brought to you by Bursa Malaysia in collaboration with our company Excellent. I'm Sibai Saw. I will be the moderator for today's webinar session. We are privileged to have Calvin Chin today to share with us this informative session, as the title suggests, how you can trade like a machine. So what will this topic cover today? Well, stay tuned till the end where Calvin will elaborate more on this topic in greater details. I noticed there are more people here just enter this webinar room. Before we begin, a quick final sound check. Type in 222 in the chat box or give us a thumbs up to confirm that you can hear me clearly. And if needed, you can adjust your volume settings to ensure optimal sound quality. All right, thank you very much. And to ensure you can enjoy the smoothest and highest quality video experience on your side, I highly suggest that you turn off your video camera during the session, as this will help ensure that everyone can enjoy uninterrupted webinar session and have an optimal learning experience. Our session for today will be divided into two parts. The first part will be presented by Calvin. Following that, we will be opening up for a Q&A session where you can ask questions related to today's webinar topic. To ensure that we can address your questions, you can follow these two steps. First, you can submit your question in the Q&A box section below and then send them to all co-hosts, as this will allow me to directly capture your questions easily. And please note that due to the volume of messages in the chat box, it may be challenging for me to spot your question if you don't submit your question in the Q&A box. So along the way, if you have any question, you can type your question in the Q&A box. As this LLF Let's Learn Futures webinar series is proudly brought to you by Bursa Malaysia, we have upcoming exciting topics and more to come. Every Tuesday, we will be having this LLF webinar series that will be conducted in 3 languages: English, Malay, and Mandarin. Our panel of speakers will be sharing with you insightful knowledge and practical strategies related to futures trading. There are still more content-packed and informative topics lining up, and we will be adding to our list accordingly. So if you're interested in any topics and want to improve your knowledge and skills on futures trading, you can scan the QR code to register yourself and make sure to add it into your calendar so you don't miss out any of these sessions. Besides the LLF webinar series, we also have the LLF online workshop. This online workshop is different from the webinar because this online workshop is specially designed for those of you who are new in getting started in futures trading. In these workshops, we will be covering a full set of beginner's knowledge in futures trading. It's a step-by-step guide to enable you to kickstart your first futures contract. Each session is 3 hours. So if you are new to futures trading and would like to learn about futures trading more in details, you can quickly register yourself in this online workshop. It's entirely free and fully sponsored by Bursa Malaysia. It's limited to the first 50 online attendees, so grab your seat fast. Before we begin, it's my pleasure to introduce our speaker for today, Calvin Chin. Calvin, he is the founder of Calvin Grayson Asset, a proprietary trading firm specializing in trading Bursa derivatives products. He has vast experience in the IT and palm oil plantation industry. Besides that, Calvin is also the author of a technical analysis book titled Profiting from Any Market. So without further ado, I'm delighted to hand over the presentation to Calvin. Calvin, there you go.
So today's topic is trade like a machines. So Sibai already helped me to introduce myself, so I'm not going to do it again. So we go into this disclaimer first. So today's all the content is for education purpose only. There is no recommendation of buying or selling any security product. Okay. Okay. So today we are going to look at 4 items here. So the first items are we are going to explore the impact of emotion on trading losses. So one of the problem in the trading industry, trading is the we are not able to disciplinedly execute our trading plan. So this mistake make up most of the trading losses. So which is today's topic. Okay. Then the next we will go into how and why we should trade like a machines and why the trade like machines will outperform the market average. Okay. By removing the emotion, we can outperform the market average. Okay. Then after that, then we move into the third item, which also we'll discuss on how we can automate some of the steps so that to avoid any emotional move. Okay. Then the last item will be the strategies or ways to keep your trading plan relevant. Meaning that as you trade, the market will change the structures. So how do you keep your trading plan aligned with the market changes? So that will be the last part. Okay. So we'll move into the first part. Okay, exploring the impact of emotion on trading losses. Okay, let's do an exercise, or maybe we can call it a game. So by looking at this chart, so what you will do? So are you going to say the chart next move will be the sideways, moving up, or going down? So let me get my pen. Okay. Okay, let's say for example okay, let's say for example from here, if you think it's going to go sideways, you type a 2. Okay, if you think the market is going to go up, you type 1. If you think the market is going to go down, you type 3. Okay, so you may type it on the chat box. Okay. Let's see where is my chat box? Let's see. So a lot of people 3 and 1 it means I either this one or this one okay, so we'll see okay, we'll see. Okay, it's a sideways, so it's 2. Okay, so I draw it here. Sideways is 2, up is 1, down is 3. Now from this point, where do you think the market will move? Is it 1, 2, or 3? Okay, let me see. Okay, so a lot of people also say up and down, but not much people are saying is sideways. So never mind. So we'll go to next move is up. So how many people are guessing it right? But I would think that it's not all of you can guess it right. So maybe some of you. So from this point, where do you think the market will go? 1, 2, or 3? 3. Most of the people choose 3. So that means it's going up. So let's see. Is a retrace, is going down. So from now, where do you think it will go? Okay. I think a lot of people still aiming for uptrends. Let's see. Let's see. Yes, I think those people choose for uptrend. You get it right. Okay. How about next move? Yeah, sorry, I make a mistake. So I click. I show you the answer already. But from this point, where do you think it will go? So we have a division here. So some say is 1, some say is 3. So let's see. 3 is correct. Okay. Okay. So how about now? So where do you think it will go? Okay, a lot of people say it's sideways. Sideways. Let's see. We can say it's a sideways. Okay. But the objective of this exercise is to gauge any one of you you get it all correct or not. So if any one of you get it 100% correct, can you type O ALL? If you cannot get all correct, right? You say no. Okay, I think most of people is no. So that's normal. That's normal. So the market, we cannot guess the market. So that's the takeaway. Okay. Next, let's ask the ChatGPT, our AI friend here. What is the percentage of traders who are profitable? So the answer is 5 to 10% of retail traders are consistently profitable. So only 5 to 10%. Okay. Then we ask another question. How many percent are there break even? So it's 30 to 40% of the traders breaking even. Okay. Next, we'll ask the last question. What is the percentage of traders who are not profitable? That means losing money. It's about 50 to 90%. So you can see most people in the market are losing money. So there are a lot of reasons for this. So in ChatGPT, he point out five factors. The first one is lack of trading education. The second one is emotional factors. The third one is poor risk management. The fourth is inadequate trading strategy. And the last is market dynamics. We will discuss this later, but let's move on. Okay, so based on the ChatGPT result, we have winner about 10% among us, 30% break even, and 60% are losing money. So meaning that people are trading, most of them are losing money. Okay, so right now what we are going to do, what we're trying to do right now is to be the 10%. Okay, so meaning that we have to change ourselves to become the 10%. Okay, but before that, we need to understand where we should improve ourselves, which part we should improve ourselves. Okay. We move on to the next slide. So by looking at the example just now, so what happened is that when the price moved down, our emotion changed to very bad emotion. Then the price moving sideways and our emotion become muted. And then after that, once the price goes up, we are happy. So from sad to happy in just a few candles, okay? Then retrace, then you feel not happy, not so happy already, okay? Then the price go up again, and then you feel super happy, okay? And so on and so on. So because of this change of emotions, it influences your decision making, okay? So when you didn't not able to make a rational decision making, then you might end up on the losing side, okay? So to make the things worse, okay, some of you might choose to become a day trader. So this is the day trader's statistic. Only 1% can be the winner. 97% are loser. 2% maybe barely can escape from losing. Okay. So why is it so? Why is it so? What's the reason behind it? Okay. So we look at the streak statistic, probability of running streak. Streak is a consecutive win. A consecutive win for our case here. It can be consecutive losing also. So streak run is consecutive win. So for us to be always winning, is near to impossible. There is one time we will lose money. So most of the people blow their account. It's because of just a few of the trade that they don't want to cut loss, or they do not willing to execute the cut loss, which is emotional factor. Okay, so because of the ego they have, they think the market will turn back to the direction. So they do nothing, or they don't want to stop loss, but the market keep going down and their account blow, and that will be the game over for that trader. So for this incident happen, it is because of emotion, not discipline. Okay. Okay. So we go back to the previous slide. Okay. So in the ChatGPT, we have 5 items highlight. Okay. So the first is lack of trading education. For this, I think everybody is very hardworking to get any knowledge that they can to excel in the trading business. Okay, so but the problem right now here is most of the losses is done by experienced traders. Okay, so the experienced trader lose money is because of just a few trades, maybe just one trade or 2 trades. They blow their account, and that will be the game over for them. So the reason why, the reason is number 2, emotional factor, the psychology aspect of the trading process. Okay, because the ego not to cut loss, maybe not disciplined on following the trading plan, so they simply enter a trade which they should not. then they end up in a losing side. Okay. The third one factor is the poor risk management. Risk management very important in trading. So risk trading is basically an emotional game. Also is a probability game. Okay. So we must trade with a positive risk and reward ratio. So, but today we are not going to zoom in too much on risk management. So we will carry on. Okay. The fourth item is educate trading strategies. So for us to excel in the trading, we need to have a tested strategy which can give us a winning, high probability winning result. Okay. So the strategy might not win every time, but it should win most of the time. Okay. Okay. The last item is the market dynamics. The market dynamics is like, for example, is suddenly there is a news coming out and the market is just move up and down and so on, very volatile. And that one is we cannot control and we cannot foresee and we cannot predict as well. So the item number 5, we cannot control. The only way we can control is risk management. That means if, let's say, the market dynamics do happen, we control the risk. Okay. So that if we win, it's good. If we lose, we don't lose too much. Okay. Okay. So for these 5 elements, the middle 3 is the one that we can control. Okay, which most trading education stress on. Okay, so we will go to zoom in to have a look. In trading, the successful trading, the trading system which contribute to a successful trading is only 20%. But most people are try to learn from all the educator is about this trading system, but that is not that's only 20%. Okay, so the other side which is more important than the trading system is the risk management, which encompass is about 30% of, and then psychology is a 50%. Psychology, which also cover the emotion. So which is today's topic. So if, let's say, we can do at the psychology element side at a satisfactory level, so we should have a 50% winning only. Okay. Okay. So we go into the trading is an emotion game. Why emotion is important? Because emotion influence our brain to make decision and action. So if, let's say, the emotion or the brain is not asking us to cut loss, we will not cut loss. At the end, we might suffer a loss. If the brain asks us to disciplinarily follow the trading plan, and it's influenced by emotion because maybe we have just a few big win, so we skip a few steps and we buy in a trade which is not supposed to be in, and we make a loss on that. Okay, so emotion, it will affect how we make decision and actions. Okay, next is emotion influence the decision making, which lead to irrational decision, and of course it will influence our rational decision making process. So it can be rational, it can be not rational, because if our emotions say, okay, we are disciplined, follow the plan, then we are rational. If our emotion affect us, which result us not following the trading plan, then we are irrational. Okay. Then the third item is even we make a decision, even we do the first part, which we follow the trading plan. Emotion influence our body to perform an action, which may lead to no action. When, let's say, for example, when the price shoot down and it's supposed to be cut loss, but because your emotion influence you and you think that the market will turn back again and you didn't do anything, at the end, maybe this trade will will lose all your account fund. Okay, so maybe one trade or two trade, you will be game over. So we have to be very careful about this. So when we have emotion, when we feel that our emotion is not stable, we should stop trading. Okay. Okay. The fourth item is emotion also may introduce time delay in your decision making. So when you are very sad, maybe you suffer a few losses, or maybe you have some family problem, something work issues or something like that. You cannot focus. When you cannot focus, you try to follow a trading plan. You have to go through the trading plan a few times before you can arrive a final decisions. That will delay your time in making that decisions. So emotion also will delay your decision making. Okay. So in conclusion, psychology element govern human discipline and executions. So this part is very important. It's the most important among the three elements contribute to the successful trading. Okay. So right now we look at how our emotion move by the market, move by the price. Okay. When the price are at low zone, so we are not so excited. So whatever bounce, we don't believe it will be going to shoot up. Okay. So once it shoot up already, then we got some hope already. Then we feel more happy. More happy, and then if the price shoot up again, then we become super happy. Then end up with euphoria. So happy until you lost your mind. Okay. And then after you have this state of emotions, you high chance you will make irrational decisions. So at the end, maybe you end up with buying more at the high price. Then the price start to shoot down. And from a super happy, you become a super sad. After you feel very sad and then it still go down, and then your emotion become angry. Okay. And then after that, you become a depressed. Okay. You think the world is going against you and something like that. So you depressed. Okay. So this is the market cycle psychology. Okay. So how we can benefit from this market psychology? First, we divide it into 4 parts first. Okay. We divide into 4 parts. The first part is the price at low zone. The second part is the price start to go up. The third part is the price shoot up, shoot high up in a very steep angle. And then the fourth part is the end of the game. That means the price shoot down. Okay, so we divide it into 4 parts. Okay, so just now the 4 part correspond to this participation chart. Okay, the first part is number 1. The second part is number 2. The third part is number 3. Then the fourth part is number 4. Okay? Okay. So, you see, the first part, most of the people will not notice it. Some, maybe the smart money will start to build up the position, which is the accumulation phase. Once they already have accumulated enough already, the market not do not have a lot of supply. Okay, do not have a lot of supply. So if people keep buying, then the price will go up. Okay, once it go up, it will attract institution investor. Then the institution investor go in for many reasons. One is maybe is for hedging. One maybe the other one is for profit. Okay, so many other reasons. Okay, so it doesn't matter. So the price go up, the institution go in at stage 2. Okay, then after that, the media start to advertise, start to reporting that the price, let's say for example, FCPO price is going up. And a lot of people read the news and then got a lot of attention. And then the public start to come in. The early batch, it will ride the trend up. Okay. The later batch, it will buy at the high. Okay. So when the public buy, who sell to them? Is the smart money and the institution sell to the public. Okay. Once the smart money and institutions sell to the public, then they are off the market. Left only the public go to support the price. Most of the time, the public are fragmented. Maybe they are small investor, so they don't have enough financial capability to support the price, and the price will high chance will start to collapse. Okay, so when it collapse, when the public see collapse, slowly, everyone one by one start to release, liquidate their positions. So when too many people liquidate the positions, then the price will start to shoot down. Okay, at a very steep angle. And then after that, it will quickly go to the lower part here. And then all this retail will become miserable and they will lose money. They will sell at a low price. Okay, so that is the stage 4. Okay, so for us, we need to catch the trend. We either go in at the first stage. If we are not smart enough, at least we follow the institution investor. We go in at the second stage. Okay, which is the starting point. Okay, the starting point. Okay. So right now, the first part, we understand the emotion is very important. And what caused the losses? We will dive into the second part. Why trade like a machine will always outperform the market? Okay. Trade like a machine is trade a strategy, a well-tested strategy without emotion. It means following the plan. Okay. So first of all, you need to have a strategy. Okay, here I will give you an example strategies. And then this strategy, we will have a few examples at a few slides later to show you how we can make profit just by following strategies. Okay, first, the first criteria is the psychology aspect. We need to be disciplined in executing the trading plan. Okay. Okay. So, and then the next, we need to work on the risk management. The risk management. Okay. So the risk management side, we need to have a positive risk and reward ratios. For this example, we are going to fix into the 1 to 2. That means we will risk one part of the risk, and then we will try to catch two part of the risk. That means we are willing to lose $1 to get $2. Okay. Okay. So, and then the last criteria, last step is to protect the trade once attain 1R profits. Example, if let's say we are using $1 as one risk, once we earn $1, we will set our stop loss to break even. Okay. Then the last part, it will be a trading system side. Okay. Trading system. First item is look for a break of structure. Okay. What is a break of structure? Break of structure is let me do okay. Grab my pens. For example, if let's say for example you think the market will go up, so it should make a higher high and higher low. Okay. High, low, higher high, higher low. Okay. Higher low. Okay. So this is an uptrend structure. So what is a break of structure? Break of structure is when it break of previous high, this will be break of structure. Okay. So on the other side, if we let's say it's a downtrend, it's a downtrend. So it should go down, retrace, go down, retrace, go down. So in a downtrend, you have lower high, lower low. Okay. What is a break of structure for downtrend? Is break of previous low. It will be break of structure. Okay, break of structure. Okay, so once we found a break of structure, what should we do? We will buy when it break above. Break above means break of previous high. Okay, previous high, we break of previous high, we buy. On reversal up signal in the next retrace. Okay, meaning, for example, this one, we have a break of structure already. We have break of structure. Then we let it go up, and then it retrace, and retrace, and it start to go up here. Then we buy here. Okay, we buy at the reversal up signal in the next retrace. Okay, then for downtrend, we spot the break of structure. This is first step. Okay, we spot the break of structure, and then we let it go down. Then it make a retrace up, and it has a reversal down signal here, and we sell here. Okay, so that is our strategy. Okay, so we'll put it into a practice, see what will happen. So for example here, this one is obviously is a downtrend. So we mark here. This is the line and it break. Okay, it break, but it break and then it reverse. Okay, so this will be the retrace. Hold on. This will be the retrace. Let me grab my pen. Okay, so let me erase it first. Okay. Okay. So this is the retrace. This is a retrace, and in here you see a reversal down. In the next candle, we initiate our sell. And for this trade, it's a win. Okay. One part, 1R here. In here, 2R. Okay. So we risk, let's say for example, we risk $1 and we win $2. Okay. So we carry on. So that's our strategies. Yeah. So next, we see it break up, but the retrace, this retrace go beyond here, So no trade, no trade. So this trade is not valid. Okay. Next, next we see the break of structure here. We wait for it to retrace here. Retrace and reverse, and we short, we sell. Okay. And this one also is a win. It's a win. This one also is a win. Okay, we carry on. So another break of structure. We wait for retrace. Okay. Then we see another reversal. Then we short again. So this one also another win. Okay. Then this one also is a break of structure, but it should beyond here. So this one is a no trade. So we will set up here. We break of structure here, and then we wait for retrace and reverse here, and then we buy. Okay. So this is how we trade using the strategy just now we have formulated. Okay. So far, I think 4 trades are winning trades. Okay. So this is daily chart. This is daily chart, 1 day chart. Okay. The same strategy you can use in different time frame. Let's say, for example, here is a 1 hour chart. Okay. 1 hour chart is the same. We'll do the same. Use the same strategy. Okay. So we spotted a break of structure here. We wait for retrace. And the retrace is here. And there is a reversal. We buy. In here, it 1R. It shoot up 1R. And then we move our stop loss to break even. Okay, we use our stop loss to break even. Unfortunately, it doesn't hit our TP. Our TP is here. Doesn't hit our TP and it go down. And it hit our break even stop loss. So we lose 0, nothing. We lose nothing. Okay. Then we have another break of structure here. Okay. We wait for retrace. And we do a short here. Okay. and then I think this one also is no win. This is not a win. It's break even. Okay, the next one is also another break of structure here. So reversal happened here. And it's also a no win here, no win here. Okay, but we already moved the stop loss to break even, so we are okay. So this one also same lah, okay. And this one is no trade no trade because it retraced higher than the previous high, so no trade okay, so no trade. Okay, so at the end we have our statistic here. Our statistic. We conducted about 10 cycle. The first we start with 100. Then first trade we win then the second trade we lose. We no trade Then the third and the fourth and the fifth we do a trade and then it's a win So we win 2 We risk 1, we win 2. Okay. So our profit turn into 108. So assuming that just now there's one trade because a lot of price movement so I say it's a no win but assume it's a win assume it's a win. Okay. So the second chart give us another $2 Okay. The rest is either break even or no trade. Okay. At the end, after the 10 cycle, we have 10%. We earn 10%. Okay. So we tabulate our performance. Okay, our performance so our performance is very simple. We plot our equity curve. So what we want to see in the equity curve is one line going up in general. One line going up in general. Any drop, we call it a drawdown. Okay. Drawdown should not exceed 10%. Drawdown should not exceed 10%. If you exceed 10%, maybe you should stop trading first, momentarily. Maybe take a rest, maybe take a vacations. Then after that, then you come back. Okay. So we calculate our metrics. The return is about 10% based on the result just now. Win rate is about 62%. Drawdown is 0 because we move our stop loss, it's protected, so we lose nothing. Expectancy is a matrix whereby you can say, if I put in a trade now, what is the result? In here, it indicates 1.24, meaning that I will win, I will make a win, okay? 0.24 more than my risk, 0.24 my risk, okay? Let's say, for example, I risk, let me see, where is my pointer? Okay, I risk $1. My expectancy is 1.24, meaning that I will get back 1.24. Okay, every time, I don't care whether I lose or win. At the end, if I summarize it, if I sum it up, I will get 1.24 for every risk I take. Okay, meaning if I take 10 risks, I times 1.24. This will be my 1.24, my estimated profit. Okay. My estimate profit is 2.4. My estimated profit. The one is is my capital. Okay. Okay. In the chat box, I see there's a question. Is it called winning ratio? It's not a winning ratio. It's an expectancy. It's different. Winning ratio is a win rate. Winning ratio is a win rate. So it's different from expectancy. Win rate, how does it differ from win rate? Okay. Win rate meaning that if you place a trade, you win, you count one. Okay. For example, you win one, then you count one. Okay. But doesn't mean you earn money. So if let's say, for example, you win $1, but you lose, when you lose, you lose $2, meaning you still lose $1. So the winning rate, maybe this one win rate is 50%. So you win once and you lose once. It's 50%. But actually, your profit is losing money. You win one, you lose one, it should be break even, right? By so-called, if you use the normal calculations. But because of the different risk and reward ratios, then you might end up in losing money. Okay. So the win rate doesn't mean that you will earn money. Okay. So whereas the expectancy, the formula, okay, is in the layman term, basically we put in $1 risk, how much you can get back. So from here, 1.24, meaning that you can get 24 cents more when you put in $1. Okay. So, but if you want the formula, it's very simple. It's average win times average win rate. Okay. Average amount win. And then you minus average loss rate times average amount loss. Okay. So this will be your expectancy. So the formula is a bit long. So I think you don't need to remember it. So there are a lot of software can help you to calculate. So if you see a positive expectancy, positive by mean more than one. More than one, that means the trader most of the time will make a profit. So if you have a less than one expectancy, meaning that you still need to work hard on your skill. Okay, next one is a Sharpe ratio. Sharpe ratio is for people to compare one strategy to another strategies. Okay, the formula is very simple. Is your return, your win rate and your return percentage minus the FD rate. So this, I assume our FD rate is 2.8. So you minus 7.2%. That means this strategy is 7.2% better than FD. Okay. So risk and reward ratio is 1.2. And consistency score is 80%. Okay. Consistency score 80%. So meaning that this performance will high chance we will keep it. High chance we will keep it. Okay. So because it's consistent. Consistent means that we don't have a big drop. So here we don't have a big drop like that. We don't have a big drop like that. It's always like this, go up. So it's consistent. So if you have a trader have a different shape of the equity curve. For example, we draw it another one. Okay. For example, your trader is you lose money, then go up, then come down, then like that, like that, like that, like that, like that, like that. Meaning that this trader is not consistent. It's by luck. This trader is playing with luck. Okay. Okay, let me see. I mean reasonable level or benchmark to Sharpe ratio have an optimum benchmark level. I think as long as it should be a relative comparison between different strategies. Okay, for example, it's more on portfolio management. Let's say the portfolio. Okay, portfolio A have a 8%. Okay, and portfolio B maybe have a 2%. So if you compare these two, it will be portfolio A is better than portfolio B lah. But if we get the Sharpe ratio, this one is negative 0.08. Okay, 2% minus 2.8%, which is our FD rate, then you get a minus 0.8%. Minus 0.8. So that means this manager is below par. Meaning that you no need to put money to this manager. Okay, you take the money, go to put into FD. The performance will be better than this portfolio B manager. So that's the layman terms of how you describe Sharpe ratio. Okay, you can say it's a benchmark. You can say it's a benchmark, but it used to be to compare different portfolio performance. Okay. Okay. So next, I have a question to all of you. Among all these metrics, which just now I have described one by one, which is the most important in investing? So number one is win rate. Number two is drawdown. Number three is expectancy. Number four is Sharpe ratio. Number five is average risk and reward ratio. And number six is consistency score. Which one is the most important? Okay, I see a lot of six. Some give three. So some give three. A lot of six. Okay, so I think all of you are correct. All of you are correct. But if let's say we want to say most important, it will be number six. It will be number six. Why? Why? Okay. You look at here. We have to categorize each of the 6 items into these 3 categories: trading system, psychology, and risk management. Okay. Win rate is what? Is a trading system. Drawdown is a risk and reward. Expectancy is profitability. Expectancy, I think it will be somewhat trading system and risk and reward. Sharpe ratio is basically compared to portfolio. So it's basically performance based. It's not so much on traders. Okay. Then the risk and reward is the probability, which is risk and reward. Risk is a probability. Okay. Consistency is the psychology side. Okay, which is the emotion. So the emotion part, you see here is actually command 50%. Okay, so the consistency is the most important. The most important. Okay, later on in my last slide, I will show you why this is most important. Okay. Okay, then we move into the section here. Basically, how we can automate some of the process. Okay, automate some of the process. Because we are human. We are very emotional. So if let's say there are certain steps we can automate, let the machine do it, then it will remove some of the possibility we get emotional. Okay. So in this use case, I'm going to use the QST as example. There are many platforms on the market, but I'm using QST, so I use the QST as an example. So you leverage on the platform automation features. Okay, in QST we have alert system. We have alert. Okay, so and then we have the OCO order also. We have OCO order for us to set the exit price. Either we exit by stop loss or exit by target profit. Okay. First, what you need to do is you configure an alert when you see you want to detect a break of structure. So you set an alert at this price. Okay, maybe 3006. Okay, 3006. You set alert. Once it's triggered, then you have a pop up on your screen, and then you look for a retrace. And then it reverse, then you buy. Okay. Once after you buy, then you place an OCO order. OCO order, meaning that you place a stop loss here, then you place a TP here. So OCO means one cancel another, meaning that if the stop loss is executed, the TP limit order will be cancelled. Okay. If the TP order is executed, the stop loss order will be cancelled. Okay, that's OCO order. Okay. So by using this automation, it automate your break of structure detection and your exit. Okay. Okay. So for this is a winning trade. Okay, so how do we set it? So you look in QST, you can see something like alarm here, alarm icon here. Then you click it, then it will throw out alarm dialog box. Then you set your alarm with the contract you want to track and the condition, and what's the price you want to detect. And then after that, you click OK. Then it will activate it already. So in here, you can type any message you want, whatever message you want. Okay. Okay. So alert is set up already. So once it's triggered, then it will have a dialog box pop up on your screen. Okay. Then you will start to look at the retrace. When the retrace finish and you see a reversal, you take action. Okay. Okay. So this is how you set OCO order. You put in your entry order. Okay. Then you right click and then you go to contingency. Then you select attach OCO order. Okay. Attach OCO order. Then it will give you a dialog box like this. Okay. This one, you can set stop loss. What's the price? You set your price here. Okay. Then the next tab is the profit. Then what's the price? You set. Once OK, you press OK. Okay. Then these two order will come up. Okay. This is OCO order. This is stop loss. This is TP. Okay. This is entry. Okay. So if the price go down here, then you hit your SL, and then the target profit limit order will be cancelled. Okay. If let's say the price shoot up and hit the limit order, the TP limit order, then the stop loss order will be cancelled. So there will be no duplicate order lah. Okay. So but this function you need to have the platform running before it function. Okay, you cannot switch off the computer. Okay. So the last part is almost the end already. This is the last part. Okay. How once you have all the strategy working and everything, how to keep relevant your strategy relevant to the market because the market is always changing so you have to adapt your strategy to the market not the other way around. So how to do that is measure your performance daily. Like just now we keep track of the equity curve, the drawdown, the profit, then the win rate and so on, the expectancy and so on. So if you find that your expectancy is dropping or your consistency is dropping, then that's when you need to look at your trading plan again, see any place you can improve or not. Okay. And then keep a trade journal. Record all your trade, and then for every trade, you should have a reason to go into the trade, reason to exit the trade, and what you have learned from this trade. Okay, you have to always review each of the trade. Okay, to find out any possible improvement or not. Okay, then the third one is review every trade for improvement. Okay, then the fourth is implement improvement to your trading plans. Okay, then you repeat this process and repeat every day. You repeat, then it will keep your trading plan to the market. Okay. So how you go about in your trading career? So you should start with okay. You should here. You should start small. And try to get the winning feeling. That means you try to get the consistency. Okay. You try to get the consistency. Once you get the consistency already, I mean you will keep winning. In general, you are winning. Then you scale up. Okay. Let's say for example, you have right now you have a 10,000 capital. 10,000 capital. Let's say for example you risk 1%. Maybe it's $100. Okay, but when you start maybe you just start to risk $1, and then you try to get $2. Once you get the consistency, then you scale up to one risk is $100. Okay, then every win you get 200. Okay, this is the second stage. Then after that, you should have a consistent profit. Okay. Then the next job you need to do is to increase the risk and reward ratio. You increase this one. See how much you can increase. Okay, it depends on product. So you can try and error. You try to increase 0.5 every time, 0.5. Then up to one level, maybe you will start to see losses already. Then you can stop. Okay. Then stop trading when exit portfolio risk. Then after that, you keep scaling up. Then at one point, maybe you need to stop. Maybe because your capital is not, it cannot be scaled anymore. You need to earn more money before you can scale. Okay. Okay. Then after that, you repeat the just now the process to learn the process, to check your performance, to see any place we can do improvement and so on, and then make improvement to your trading plan. And then the cycle will keep on going and going and going. Okay. So lastly, I give you this slide. Okay. So this slide is every successful trader should have lah. It should have a consistency, discipline, confidence, patience, passion, sharing, and helping others. Especially the number 7 and number 6 is very important because by helping others you learn the mistake made by others people which do not cost you any money, but you earn the knowledge. Okay, so it will not, the same problem, hopefully it will not repeat on you lah. So you earn the experience, so you progress faster. Okay, so I think I finished my slide already. So I think maybe CY can take over.
Thank you very much, Calvin, for your informative sharing. I believe many of our audience here have learned how to trade like a machine. So it's now time for our Q&A session. And if you have any questions related to Calvin's sharing, can you simply type your question in the Q&A box? And remember to send your question to the Q&A box so that I can easily capture your question there. While waiting for questions to come in, for those of you, if you don't have any questions, I would like to ask a small favor from you. I would like you to take a minute of your time to fill up this feedback form. Since we have already provided you an informative session for today, it takes you less than 1 minute to fill out this feedback form. You can find the link to the feedback form in the chat box below, or simply you can use your mobile phone to scan this QR code. So just take 1 quick minute to share your feedback will greatly help us in improving our future sessions, ensuring that we continue to deliver valuable content that helps you enhance your learning experience. So please take 1 minute to complete this form and we will begin the Q&A session soon. So I will give you 1 minute and we will continue after 1 minute. Another 30 seconds to go. All right, so 1 minute has passed. If you have already submitted your feedback, I appreciate that. Thank you very much. While for those of you who haven't finished yet, you can continue to finish it while I continue with the Q&A session. So let's continue with the Q&A, and to ensure we have sufficient time for all questions, I will be selecting the most relevant questions from the Q&A box. I will also restructure some of your questions so that it is easily understandable for everyone. And please note that due to time constraints, we may not be able to answer all of the questions. So Calvin, here are several questions for you that you have shared earlier. So the first question would be, how do we know that trading strategy is more important than trading psychology?
Okay, you can hear me?
Yeah.
Okay. So I think the correct there's a correction. The trading psychology is more important than the trading strategies. The trading psychology is about 50%. So the trading strategies is only 20%. Okay. So the executions the discipline is under the trading psychology, emotion as well. Okay. So trading psychology is more important than the trading strategies. So okay.
All right. The next question. Earlier on, you shared about one of the
Okay.
trading strategy where there are several rules, right? So how do we find the point of a retracement?
Okay. I just add on a little bit of info on the previous questions. Is this result actually is done by one of the US universities. So they come up with this which one contribute to a successful trader. Okay. Okay. So you can look into the internet to find out. Okay. So the current question is how to find the point of retracement.
Yeah, that's right.
Actually, after the break of structure, you see any price coming back. Once the price coming back at the support level, so you have to understand, maybe mark all the possible support level, and it bounce from the support level. It could be a reversal from the retrace. So what you need to look for is the support level. Okay.
All right. Earlier also in on the trading strategy, right, you mentioned about the break-even point, moving our stop loss to break-even point. So on the break-even point, right, how do we find our break-even point? Because there might
Okay.
be some
It
participants might not
okay.
understand this.
Okay, if you enter at price $1, your break-even point will be $1. So that means you at $1 you will lose nothing, break even. So the break-even point will be $1.
Okay, so
Let's say, for
break-even.
example, another example, if let's say you enter the trade at $2.50, then your break-even point will be $2.50. Of course, you can add in whatever commission you pay for lah, but for simplicity, we just ignore the commissions. So we say the 2.5 is the break-even point. Okay.
Okay, so
Basically,
basically
break-even point
speaking,
is equal to the entry price.
okay, so break-even point would be our entry price. Now the next question,
Yes.
can you recommend any books or website for a beginner trader?
Okay. Obviously, I will recommend my own book lah. Okay. Okay. Then the website, maybe you can go to YouTube and find.
All right. Is there any other book that is more user-friendly for beginner trader to read at?
Uh, I think my book is the simplest. The rest you need to read 10 books to get a strategies.
All right. Now, just now you
Okay.
share about the trading platform to do the OCO orders, right? Which can you
Uh,
repeat again? Which trading platform can have these OCO order features?
Actually, a lot of this a lot of platform can do this. Just now, in the example, I used the QST. So you can ask your broker for QST platform.
Okay, so for those of you who would like to learn or use OCO or order features, right, you need to check out whether if your futures broker do provide this QST trading platform. Now, the next question would be, Calvin, can you name what are the three most frequently made mistakes by beginner traders and how to solve those mistakes?
Okay. I think the uh most most of the time the trader lose money is because of the psychology element as well as the risk management portions okay. And then of course the third one it will be they don't have a reliable trading system okay. So psychology part is because maybe the strategy say you should cut loss and they don't cut loss so it's a human issues okay. Then the risk and reward over most of the time maybe they see okay people are going in they also want to go in they want to join the party but they forgot to calculate the risk and reward ratio okay. So even though they win a little bit only, but they lose big. So that is the second mistake they might suffer. The third example is the trading system. They don't have a reliable trading system. Okay, but this one is the least important It's only 20% only. So the trading system, as long as you have a win rate of 42 or 43 win rate, I think you are good to go. Okay, you don't need to have 50-50. 42, 43, I think should be good enough. With the risk and reward and the psychology element go in, I think you should be a profitable trader.
All right, great. Now, one more question before we end today's session. Now, let's say we have experienced consecutive losses. What can we do?
Stop trading, then take a vacation, go do some shopping.
And following with that, let's say we take a vacation to cool off. And how do we know we are ready to, get back into trading again?
Okay, then you go back to do a demo account. You use whatever you have learned and start to do trading until your expectancies and expectancy is more than one, and then your consistency is about 70% above.
So, Calvin, you mentioned about consistency. Does consistency meaning making profitable trades or consistency about executing trades correctly?
Consistency meaning that you make profit overall. In overall, let's say for example, in 1 week you make profit and every week you make profit. That is consistency. If you make 1 week and then you lose the other week, and then you make 1 week and then lose in the other week, then it's not consistent. So if you make money every week, you should make money.
Okay, so
regardless whether it's more or less.
all right. So what Calvin mentioned about consistency is that we got to be able to be profitable most of the time, right? Now, I think it's about time. Thank you very much, Calvin, for answering our participants' question, and allow me to conclude today's webinar session. Once again, let me promote our upcoming webinar, especially for those of you who missed out this announcement earlier. This is the LLF Let's Learn Futures webinar series. It is a series of topics where we will be conducting almost every Tuesday evening, same time from 8:30 p.m. to 10 p.m. There are lots of content-packed and informative topics where you will be learning some practical knowledge about futures trading from our experienced speakers. So if you would like to join any sessions, you can scan this QR code and register the topics that you would like to attend. Once you scan the QR code, you will come to this page and there will be an event calendar. So if you would like to join the upcoming session, you can find the LLF webinar topics on Tuesday column. You can click on it and register yourself accordingly. Besides that, we also have the LLF online workshop. This online workshop is different from the webinar series. This online workshop is specifically designed for those of you who are still new in the futures market. So if you have interest about futures trading and would like to learn futures trading in detail, then this online workshop is definitely right for you. You can pick up your phone, take this picture or screenshot this page and register yourself right after this webinar ends. You can share this event with your friends and family who like to learn futures trading. We will be guiding you step by step how to kickstart your first futures contract. And remember, this online workshop is limited to the first 50 online attendees only. So remember to register yourself in both workshops and book yourself a seat. Once you scan the QR code, same thing, you come to this page, there will be an event calendar. So for the online workshop, it will be on the Saturday column. There's a website in Bursa, Malaysia called Bursa Marketplace where you can find Derivatives Trading Simulator, DTS. There you can do paper trading and familiarize yourself how to use a futures trading platform. You can register yourself for a risk-free trading experience. So why not give it a try and test it out so that you can learn and begin to develop interest in futures trading. Last but not least, before we end this webinar session, let me introduce you to this Bursa Academy. This Bursa Academy is a comprehensive one-stop e-learning platform where you can get all the information and knowledge about stocks, futures, and any other products that you can trade in Bursa Malaysia. You can scan the QR code on your right here, or you can Google search Bursa Academy and make sure you are able to find this correct link. And you can access to Bursa Academy for more information. All right, this comes to the end of our webinar session for today. Thank you, Kelvin, for sharing an informative session with us. And to all of you who joined us today, thank you for your participation. We hope you found this webinar both informative and valuable. I believe you have learned lots of informative knowledge about how to trade like a machine, how to gain consistency, and how to manage your trading risk effectively. So with that, I'm CY. I'm going to signing off now. Enjoy the rest of your day. Good night, goodbye, and until next time. Bye.